Welcome to the Twomey Stock Market Report. I'm James Twomey, and today's Sunday, October 16th, 2022. All right, I want to talk about a couple of things in today's subject. We'll go over some of the market analysis, but more importantly, give you a window into making trade decisions. But first off, I just want to ask everybody, did you get the buy alert on 8/12/22 to jump in and buy TBT? We are up 38.3% in just 9 weeks. So if you did and you took advantage of it, it's time to celebrate, and we're still holding that position. All right, let's see. I want to review trade signals. Last week, we had much more of a technical bounce off the bottom of the market versus fundamentals. So it may be a good opportune time for us to review some of our technical and somewhat in the backdrop of the fundamentals, okay? So we look at the trend, we look at the sector analysis, among other things, of course, and then we derive some technical signals, and from that, we make some trading decisions. Pretty straightforward, right? So let's go back and go right to the charts. I know everybody's anxious. We're going to start first off with the weekly on the SPY. S&P, we use the proxy, the SPY, and here on Street Smart Edge with Schwab, this is the program that I use. I want to just point out that the COVID lows are back here in early of 2020, March, April, and we went up to the highs of the end of last year, beginning of this year, correct? So if you take Fibonacci, and I'm not a real, big Fibonacci, fan per se of that's how I trade, but I do use it as an indicator of many. And in addition to that, there are certain swing points, you call them, or inflection points that we should particularly pay attention to. Well, in this case, we had from the COVID lows to the highs on the SPY, we had a retracement last week of 0.5 or 50%. And with Fibonacci, you can Google it and look at it. There are key areas, 23%, 38.2%, 50, 61, 76.4, and then 100% retracement. In this particular case, from lows to highs, we retraced about 50% of that entire gain. And at that point, since this Fibonacci is a universal metric that is many things in nature follow symmetry, and Fibonacci came up with this formula, and it matches a lot of that symmetry in nature and in mathematics. But with that said, we hit that number, and we had a huge Thursday turnaround. So back in maybe June, July, we were talking about where could the market go when we were first starting to get into this malaise, and then we saw some of that market bounce start to develop. We had mentioned that this 50% was the first target. We have another target, would be at the 0.618 or 61.8%. I'm not in the prediction business. These are just outliers. We happen to hit this one where we hit the 0.618. Who knows, but just that was where we're talking about. If we go to the NASDAQ, the QQQs, the proxy we use for that happened to hit 0.618, right? So with 0.618, coincidentally, was, last week as well. And lo and behold, we get a bounce that Thursday run up. Of course, we gave 50% of it all back on Friday. So, that tells you something as well. All right, so what am I getting at? Let's see. So let's first go back to the SPY. Let's get on the daily chart, okay? Just give it a minute here. And what we want to do is kind of look at a couple of charts. We're going to look at the bond market. We're going to look at the energy market. We're going to look at the SPY. So how do I derive that? Well, I go right, when I'm thinking about trading and what we should be thinking about, we also have to look fundamentally, right? And we do know historically that the market has been down this year. And if you go to the Tumi Stock Market Report off of the website, TumiStocks.com, I'll show you later how to get to it. We go over the trend analysis, and I mean, it does take a rocket scientist. The overall trend for the year has been down, right? You see these red trend lines, and it's going down. We continue to hit these lows and bounce off this trend line. We're getting near it again. RSI is low. Multiple technical indicators indicating potential bounce. But with that said, that's the overall trend. So we know it's down, and how long or when is always the question, correct? So we also then add some indicators to that, and that's what I want to talk a little bit. We talk about the 200 exponential moving average. We talk about the 50 exponential moving average. The 200 is blue, the red is, or pink is the 50. Then we get a tighter one, 14 EMA, which is gold, and then the black one is the 9. And we use those as inflection points to determine, is the market on upward or downward, or is it a resistance or support level? Hopefully that all makes sense, right? So that's what I look at. We know the trend is overall down. And I know that the trend is getting exhausted because I look at relative strength index. If it's down around 30, 35, anything under 30 means the market is what they term oversold. In other words, is less sellers, and at some point buyers will bargain hunt. When it reaches up to 70, and I use mid 60s as the catalyst, it's overbought, meaning not many buyers may be around. Now, that trend can continue over an elongated period of time as long as the trend stays, in the same direction. And what do I mean by that? When we had that long bull run, Tesla kept going up, up, and up. There was times where the RSI was highly elevated on a longer period of times, but yet it was still prudent to stay long in Tesla, correct? And that certainly paid off for many. So let's take a look at, I want to look at the bond sector and why. Right here, we're at this 38% gain. Now, TBT is the inverse of the 20-year bond. It's Barclays index, right? It's an electronic traded fund. It means that when the yields on bonds go up, in other words, if a bond is paying you 1% yield, and then it moves up to 2% yield, that means yields going up. If the yields are going down, let's say it was 1%, and next week it's 0.5%, they don't move that drastically, they would say yields are coming down. So as inflation picks up, the Fed raises rates, they have to raise the yields on bonds to make them attractive for new buyers, correct? So a new buyer is saying, hey, inflation's at 8%, you're trying to sell me a bond for 1%, I ain't interested, right? So, so we would expect that TBT to move forward. Now, I don't want to make this complicated, but TBT is a 200% ETF. What does that mean? If the ETF moves, let's say $1 in a day, it records a $2 move. If it drops $1 a day, or whatever fraction, a number, or points, it's double that. So it would be minus $2. So you can also play TBT, which is the 1-to-1, and which is less risky. There's a lot of, we'll go over at some point, and we have in previous videos, the decay factor is larger, obviously, on a 200%. But if we look at TBT, I want to go to that first, because that's the one we got, and if we look at this is the weekly, and it, we had a buy signal back here, early in mid-August. We took a small entry into what I call the mouse hunt, because we got in earlier before our buy signal. It paid off. That's the one we're up 38%. And the following week, or 7 days from that, we got the full buy signal, and we went all in. Whole idea about the buy signal from the Twomey stock market report, or tips Twomey investment process, is this: we do not buy at the low. That's see around here. And we're not going to sell at the height. We're going to lose some of that at the top. But when we get the buy signal, it should be an extended signal. Therefore, you go in long, hard, and heavy. And then if we receive a sell signal, we get out. Maybe for a loss, maybe for a gain, if it's a short-term one. But the bottom line is, the goal is to not get much of a fluctuation and get a longer trend with heavier money in the long position, or whatever position you take so that you can maximize your gains. We also, once we start getting gains, we change our stop level. Initially, when we get in, we give a kind of bottom floor stop, 5%, 6%, whatever that loss might be, in case it goes sideways or we're wrong. If not, then once we get a little bit of steam, we move up our stops and we break it into thirds. The first third would be at an inflection point like 9 or 15 EMA or 14, whichever you like to use. The next one might be below the 15. And the next third we hold until we get to sell signal. And we update those as we move, as our position moves. Okay? So that's the overall philosophy. But let's expand this. So we got in back here in mid-August. And if you notice, we talked about trend track lines. The blue here. This one it has a very narrow trend track line, the Twomey trend track line. We're kind of putting this in, and it happens to follow it. Stocks don't know this. They don't care about my trend track line. It's half rear view mirror and half, hopefully, a predictor, as we say. So we look at this, and every time it kind of butted to the top of this trend line, what happened? It pulled back. We had the stock pull back. We had the stock pull back. And then when if it got to the bottom of this trend track line, it's rebounded and moved back up. In this case, we went above it. And we come down and we go up and we come down. So right now we're up near the top track line. So we're expecting some kind of retreat potentially, right? So we're on the alert for that. So that's one of our, big picture. We know the trend's going up. Big picture, and then we look at, once we get our buy signal, and we look at a few things. So let's just back up and see if we can examine that buy signal a little bit better. Right here, what happened? All right, so I'm going to go in the weeds here, so be prepared. There's 3 boxes here. This is the daily chart up in here. Down here in the middle box is what we call the MACD. These are moving averages, and they're based on, if you want, we can look at the MACD right now. What are my MACD? If you're going to set up your trading table, the MACD, the green is we use the period of 12. The red is period of 26 over 9 days, right? So over a period of 9. So therefore, we come up with the average of that number at the end of the close. What's the logic behind that? Well, okay, so it's going to be hard because we've got our volume numbers here hiding this. Let's see if I can fix that a little bit. Let's see if I can help out here. I don't know. It's not letting me do that. Come on. Usually I can, there we go. Expand this a little bit. All right, so if we look up here, we got our buy signal down around here. What happened? If you look at the MACD, the green line here had crossed above the red line previous to that, okay? We also have this middle line 0. Once we cross above 0, we say it's becoming positive. So we saw it up the green above the red for several days, almost a week, and then it started reaching near 0. And we happened to get our buy signal, and we jumped all in. And then as this expanded, and in other words, price expands up, the green line on the MACD over this period that I've just shown you, the mathematical formula breaks out and it says it's moving upward, up into positive territory. Is now 1.45. I mean, it was way down here at -5 at some point in time when at its low. So that's telling us it's an advancing, and the green means positive. The red would be negative. So once the green if the green crosses below the red, that would say we're having more price pressure and the price should be coming down. So we use the MACD in some of our analysis. And once we find out the MACD is starting to move in the right direction, and here it crossed over right there, and then our buy signal came and the green was going up and we jumped all in. Okay, so that's one of the indicators that we follow. If we look back here, we had a sell signal. See how the MACD, the red crossed over the green. It's breaking down. It breaks below zero. That's telling us there's price pressure. And sure enough, you look up the daily chart, the price is dropping. So so that's our more of a, I call it more of a slower indicator. You can see how I've circled a couple of these here where the red and green cross. Where here it's below zero. Here it crossed again. Here it's below zero. Didn't cross until over here, and then it's been positive all along. So it's not over a duration of 6 months here, right? We're looking at very few inflection points. 1, 2, 3, 4, 5, 6 since March. Okay, so that's our more. Once those things start happening in a positive nature, my antenna goes up, and that's my first signal. It's not my first signal. It's my second signal to tell me things are moving and I should pay attention and I should start looking for a buy signal. A little complicated, but just something that you have to play with and get comfortable with it. And you can Google MACD and they'll define all the status. And if you go on my Twomey stock market report, I do define it as well. All right, now. What do I use as a first indicator? Now, again, I've looked at the trend up or down from a big macro point of view. It doesn't take a rocket scientist, but that's what I want to get a feel. I want to see inflection points, the Twomey trend track line. Anybody can draw those, and you try to connect 3 points at the top, 3 points at the bottom, and look, create these railroad tracks of highs and lows over that 6 month to a year trend. And, it could be sideways, it could be up, it could be down. It could be all over the place in some stocks, right? And then I look at, I'll look at a sector and and we're going to go over that. And then that helps me look at particular stocks or indices in that sector that I think would be important to start investing in, okay? In this particular case, the trend was down, interest rates were going up. That was my alert that the bonds yields should go up and this TBT or TBF should be a good investment vehicle. That's sort of was my sector analysis on that. Okay. And fundamentally, that was how I started. I then, I won't go into it here. I do it in the Twomey Stock Market Weekly Report, the written report, where we get more into the weeds on that and give you some deeper definitions. Some are interested, some aren't, so that's why I put it in written form and something you can keep coming back to. All right, so what does that get me? What's this lower box? This is what we call stochastics. This is a much more faster oscillator. My stochastics I use, where are they here? I use a period of 14, 3, and 3. So green is the faster, red is the slower color. I don't use the %D, and I put that in, I put this also in a separate table. And this is very quick oscillator. Quickly, if it's down at the bottom, if you can see my cursor here, it's like this is it's got 8 for the green and 20 for the red, right? This one's 5 for the green and 18 for the red. Very, very low numbers. Here you see once the green crosses above the red, like you see here, and you get an upward movement, I start paying attention. As I said, hey, something's changing in the market. And if you look all the way up here, we'll skip MACD for now, you can see, sure enough, from this point on, right up here, the prices did expand. If we look at the MACD, we see the MACD green was still below. So this is a first signal. But up here, the MACD was still negative, and the green was below the red. Not until here did the green and red intersect and then cross positive above zero. So I look at that, and I tend to look at the stochastic as a first indicator of the directional movement. This is the daily chart of the market. And then once it gets up to 50 to 75, that's where I'm very interested in taking a position. I look then at my MACD. If the MACD is green, starts turning positive. In this case, we had to wait until the green got way up to, that was running around 97, a little bit high. But Then I start taking a position. And then, in this particular case, we had a buy signal we were already in, right? But that's beside the point. Anyways, if you look at stochastic here, it's how many times the green, since the same time frame we had, 6 up here in the MACD? Look here in the stochastic. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. I mean, I haven't even got from March to May. It's a quick mover. So do people trade off of that? Day traders, hourly traders? Absolutely. Can they? Absolutely. Those you may want to go in quick hits, or maybe you got big money and you want to, just get a little bit on 10,000 shares, whatever it is, you can do this. And you would probably use a shorter time frame than a daily chart. Anyways, that's how I look at the market. I use stochastics kind of like as my stopwatch. I'm looking at the sprinter, and then I want to see the MACD to tell me, this is a relay race. Did the next sprinter get stronger? Are they taking more of a lead than against the competition? And I look at my daily chart. Hopefully that gives you an idea of how we get the technical aspects. But I don't just trade off of technicals. I get into the market sector based on fundamentals. I want to make sure that fundamentally that either stock or ETF or indice or market segment is moving towards my favor. All right? I don't just trade off for technicals. We marry the fundamentals and technicals and bridge the gap between the two so we become less of a reactive trader. Once we get a buy signal, boom, we get in, we go long and hard, and then we get out when we need to. So I then add to my daily chart. I know this is a busy chart. I'm going to expand this as best I can. A black line, which is the 9 exponential moving averages. Basically, every 9 days, it looks exponentially at the pricing in the daily chart, and it comes up with a point in time. It's not a smooth average exponential, so it puts a little bit more weight in the most recent numbers. It's a very quick number, but look here. This stock, since August, since we've been in, has pretty much hugged that 9 EMA line. Don't ask me why, but it is a good indicator. Then I also add something that gives me a little bit more ability to, predict over a longer trend, and that is I use the 14 EMA. That's this gold line here. See if I can get it highlighted for us. It's overlapping quite a bit here. There we go. And see how if it broke below the 9, like right here in this downdraft, it got repelled by 2 things here, the 14 and the Twomey trend track line. Coincidental? I don't know. But it's worked over time and for me. And it, again, works once the trend is elongated. So it's a combination of fundamentals, technical, but it is an inflection point. So oftentimes I'll use, now in this case, we've got 38% to protect. What I would do is normally I'd put our first stop somewhere about right below that first 14 EMA number. In this case, that would be about 32.3. The second, third, I'd come down just under the Twomey trend track line. That would be like 31.8. In theory, if you're a Fibonacci guy, you really wouldn't do anything until the 0.23 or 23.6% retracement. But, I tend to want to protect my investments. Taking a third off at a high point like this is never a bad thing. And we can always get back in, right? So that's technically some of the ways I trade. And, I have people go to the Twomey Stock Market Report. It's on our web page, and we're going to go through a few more things, right? Right here, you can check out a sample of the newsletters. You can view some of our past trades. There'll be a video or 2 I usually post. I have one up there, I think, on trading down markets. I had one on there, midterm effects on the market and what happens historically after midterms elections. I have one on trading down markets. I had one on trading last week's technical bounce. I had one on fundamentals, cash flow, etc. So you could do that. You can also sign up to receive our trade alerts. So there you go. Take a look at it. If you want to get this on a more permanent basis, on our alerts, we send out real-time emails right to your desktop, your phone, what have you, so that you'll never miss a trade, buy, sell, or stop. Any changes to those indicators, we change our buys or our stops or what have you. We send those out real time. You have them. You don't have to wait for the weekly report. You don't have to wait for your own analysis to kick in. We do all that work for you. Pretty straightforward. The newsletter goes into tremendous detail. It's packed with all kinds of information. I don't want to waste your time here with this because you can go online and take a look at it. We have a market analysis. We go over the trend. We talked about that, right? A little bit. We give a lot of information about what's going on what happened the last week in the market. We talk about other things in the news. We talk about the sector. In this case, how oil is affecting the market. We talk about that. And then we also talk about, want to get, some of our stock trades, but also in the news of the market, but I also want to get into what we call the environmental analysis. What's going on, government spending, taxation, global concerns, fiscal policy. These are important factors that can affect the market long-term and sometimes short-term. We also get into the sector table review and RSI and advanced decline. So that want to bring me back to the sector table review. Let's see if we can bring one up real time. Yeah, there we go. Let's see if we can make this a little bit bigger for you to see. It's not that great. All right, so I usually sort this 1 month for the report. And then I'm more interested in, 1 month, 6 month, and year to date, right? So if I sort this year to date, best performing to least performing, you can see the only thing that was in green was energy. Everything's negative, negative, negative. All the way at the bottom here is consumer, discretionary, and information technology. Then I start looking to the left. How has that changed in a 6-month period, 1 month period, 20-day, and real time? Okay, so if we sort for 6 months, what's been our 6-month horizon? We're going to sort this bottom, hot, good to bad. Energy, nothing, everything's red, right? At one point, energy this year was up 50 some odd percent. We were riding that pretty high earlier in the year, right? And then this is telling me there's no place to hide. Everything's been down, and it reaffirms down, okay? And then I sort for the 1 month, high to low, and there we go. Healthcare is now -3, but it's near the top, followed by energy, etc. But all in the red. And then we look over here, what happened in the last 5 days. Last 5 days, consumer staples, healthcare. Healthcare is very defensive. Consumer staples, very defensive. Financials are creeping up there. That's because the banks are reporting. And energy and utilities way down here. So energy had kind of resurfaced. We have some energy plays. We got stopped out of one and very quickly. Materials, gold, and other sectors was also starting to show, but we got quickly disappointed and stopped out 2 of those. So, in this case, if you're looking at 5 days to 20 days, you'd say, all right, let's look at what 1 month. What would I look at? I'd look at healthcare, energy. That's about it. Everything else is pretty ugly as far as potential going along, not short. Then I would do it the 20-day. I just want to go through the logic. 20-day, energy, healthcare, consumer staples, not much change there. And then the 5-day, which we just talked about, consumer, healthcare. So let's expand healthcare. All right, healthcare, what's most biotech, and I don't like to trade biotech because you can wake up one day and see a trial drug go either through the roof or sink, all kinds of failure, try at phase 3, and all of a sudden the stock, you wake up, it was up 100 the day before, and now it's down 150 the next day. So you got to be, biotech's very risky. You can use the ETF of biotech, that helps. But anyways, that's leading the charge. This is most recent, right? After that, pharmaceutical. I mean, they're all still in the red. Nothing exciting there. Healthcare, I'm not getting too excited. Financials, anything expand there. Let's see. 20-day, 5-day. Let's see. 5-day, we're looking at mortgage. Oh, no. Nothing really there. Insurance, because banks maybe. I don't know. Banks are in the green from the day, and mortgage and thrifts. I don't know. Nothing to get excited about, but I guess you'd look at mortgage real estate investment. I personally wouldn't, but you could assume that. All right, so we're in energy. Let's take a look at energy, right? Energy, there's lots here. There's gas and oil consumables and energy equipment and service. We had one in energy equipment and services, oil and gas equipment, oil gas drilling. Oil gas drilling was the one. And that had been, if you had seen the last 1 month, there was a couple that had moved up. So this gives you some stocks to invest in. There's potential there. And then you look at oil and gas consumables. Let's see, oil refining. That was big. Who was in there? Oh my gosh, you've got quite a few in there. But that's a sector. We usually use an ETF like XLE, right? Energy equipment and services, that's usually pretty big. And then the energy sector by far has done pretty well this year. Okay, so I use that to get a lay of land. In this particular case, everything is red, and that's why we're short in the market. We're not going very far, very fast. Okay, so that gives us a little bit of idea. Of what we're talking about. What else do we want to look at? USO. Okay, we're on energy. Well, let's take a look. We are long XLE, and that had some interesting developments. We got our buy signal, and you could tell here. I mean, this energy moves very fast. It's very volatile. I wouldn't say put a lot of money into it when you do trade it, because it is a fast mover. It trades on the oil, gas, natural fuels. All those are based on the futures, what people are willing to buy in the futures, and it gets adjusted. When I say adjusted, the price gets reflected based on changes in, who's drilling, who's not drilling, and it's, heating season, not heating season, weather, you name it, can really affect the future. In other words, what's being traded months out. And then, so it definitely is a much more forward-looking trade. It is also very volatile, like materials. So you have to be careful. I don't say put a lot into it, but when it's running, you got to play it. So, we got to a bottom here. We looked down here. I was like, hey, wait a minute. Our sector table was telling us a couple of weeks ago energy was raising its head. I looked down here. Sure enough, our fast indicator, the stochastics, the green starts going above the red. I start paying attention. I look up here. The MACD is still pretty negative. The green's below the red. We're not even at zero. So I'm like, I'll keep my eyes on it. Get up to, the 200 moving average, which is the blue line. Anything above that is a good sign, because that's 200 days for something to be an inflection point. Usually it bounces off that. In this case, it went below it. Another day, another time, we'll go into that as an indicator. Right now, now I'm like, okay, the 200, that's gonna, if we do have any pullbacks, that will be the first line of support. That's a pretty big support. I'm looking down here. My stochastics are improving. They're still not at 50. My MACD, the green is still below the red. We're not at zero. I'm like, I don't have a buy-sell signal in my Twomey investment process yet. And then sure enough, 3 days it takes off. Stochastics are up over 90. MACD is cross positive. It goes over zero. Everything rhymes. 9 crosses the 14. We get a buy signal. We go all in, right? And then we issue the alert. And since then, we've had some pullback. It got reflected at the 9 EMA. Surprise, surprise. It has now gone up above, and now it's come back down to the 9 EMA. So will this act as a repellent? And it's really too short of a trend to draw a trend line, but we can try. It's still kind of early. This is kind of messy, but you can see this is not much of a lot. We can stretch this trend a little bit, but either way, it's not. See, it's a widening gap here. It's not a straight line. It's tough, but it's telling us that it's this widening gap. This price is starting to flatten out. So if the price comes down, this trend line would then also come down, pivot down, and that would be telling us the market is dropping, right? But overall, it's above the 9. We stay with our trade, and you can see it does fluctuate quite a bit, and this is priced at 80 something right now. We're up only less than 1% from when we got in. But with that said, look down here, the MACD, green, and I know it's hard to see. I already apologize for that, but the green and red is quite wide, good, positive. Green is, 1 plus, so it's good territory. The MACD, the green and red are kind of flat, but they are way up in the 76 and 80 percentile. So that's good. That's good. It's showing us breadth, that it's positive. So we're going to stick with that one. The other one I did not issue because it's extremely volatile. It's the United States Oil ETF, Electronic Traded Fund. This measures the price of oil in the United States, obviously. Looks very similar to the XLE chart, correct? It did get the buy signal about the same time. I have a position, and I added to the position, but I didn't issue it because we were playing a couple others, and it's so volatile, I didn't want everybody to have that exposure to it. And it does move pretty fast, right? And the other part is the reason, fundamentally, what's going on with oil? Well, the strategic reserves, we were releasing millions of barrels a day for the last, I don't know how long. That brought the price down. I know it doesn't sound like a lot, but it was. It helped refiners be able to, supply themselves quicker. It goes on the open market. In some cases, it gets sold and the prices were high. A lot of good things happen with that, right? Well, that's going to stop supposedly in November, and they did have recently a big drop, a big add of that oil reserve release. But if it stops in November, I would expect the reverse to happen. Fundamentally, we're also going into heating season, so I would expect that more consumption. I think supply is limited out there. Nothing's changed over Ukraine and Europe. They're struggling. And next week, we're going to talk about fossil fuels and renewables. And I'm going to show you some statistics. And it's going to really, really drive this home. But let's stay on subject here. The bottom line here is you can see how this is dropping. The red is down days, daily chart. We've dropped below the 9. We dropped below the 14. We closed. The 14 was 70.81, and we closed at 70.17. So it's closed below. So in my world, I'd be selling it. I've either sold or already sold a third of my position because it did get below the 14 EMA. If we had a position, we would have been stopped out at least a third by now. I look down here. The MACD is still very positive, but my fast oscillator, what's happening there? Green is now down below the red. And if we look at the numbers, we're down. The red is 65 and the green is registering 52. I like to be between 50 and 75. I like to be at 75 and above, over 50, I start paying attention. Well, the reverse of that, once I break 75, I'm thinking, hey, if this drops, if we don't get a bump pretty soon, this is going to drop pretty fast. And then it's a fast oscillator, and that will mean, and it's below the 200 EMA. A lot of technical stuff going on. It takes time to digest all this, but I'm just trying to walk you through it so you have a feel for it. So that is that picture. I didn't issue the buy signal because I wasn't convinced. And you can see, look at this, a lot of fluctuation. And it's a $70 stock. 10% a day is $7. It could be really, devastating to a portfolio. So hopefully that gives you a little bit of idea of stochastics, MACD, some inflection points on the daily chart that we trade and we use for stops. And once we get that buy signal. Hopefully that gives you a little bit more insight on trading. Since last week was a technical trade, we started the segment off talking about how the Fibonacci hit this inflection point on the SPY and the NASDAQ, and coincidentally, they happened on the same day or two, and coincidentally, the market raced above. And of course, we quickly gave it away because the market is very tenuous and fundamentally not very strong. Earnings are coming out next week, continue to come out next week. I expect companies to have fairly good to decent to middling earnings. They've had time to adjust for the economic malaise that's out there. We saw things like Delta. They said, hey, our revenue per seat was up. They're flying less planes. They're filling all their planes. They're charging more. The fuel prices were up 48%, but they still made a very good profit. They feel they've narrowed their window of negative, planning, if you will, and they're planning for, even robust. And of course, we're going into the holiday season with a lot of traveling. So they feel very positive about what they're doing. But they're flying less and they're making more. How do companies do that? They do it by a couple of things. If costs go up, they have to reduce costs. How do they reduce costs? They take away underperforming, in this particular case, routes, right? They fly less routes that are underperforming, where they can't fill the planes, or they reroute those through hubs. Now, we travel a lot. We go places what used to be direct flights, and now we have to take a stop. Very frustrating as a traveler, right? And then the planes are chock full. Sometimes there's long layovers. It's all part of traveling, and we're paying, double what we paid, a year and a half ago. Of course, that was COVID times, but even before COVID times. So it's, they've adjusted, and that's what companies do. Companies will eventually say, hey, we're not going to hire as much. We're going to make less. We're going to charge more. And as long as the consumer can pay it, we'll cut costs elsewhere. But you got to remember, if they start laying off people will have less jobs, less income. They'll have less money to spend. Then the company's higher prices will not work. So we're right now, we have high unemployment. Low unemployment. Yeah, low unemployment, very robust employment market. We've heard a lot of companies holding back, cutting hiring, especially in the high tech, style layoffs. It's coming. How much? I don't know. If it stays, 3 to 4 to 5% unemployment, that's a pretty good number. Even in a bad economy, 5% is not bad. So we'll be able to weather this recessionary storm. If it really gets bad and something drastically happens, like the financial crisis, then all bets are off. Once people lose their jobs, companies can't afford to keep workers. They won't be able to charge higher prices. People will definitely pull on their horns because they don't have the money, et cetera, et cetera. We're not there yet, so we don't have to worry about it. So hope that gives you a little bit of a background of what we're looking at. But what I'm saying is I think companies are going to come out okay. There's not a lot of negative news on the horizon unless it's some catastrophic event. We're seeing that in Europe mostly with this liquidity problem, so we've got an eye on that. The Fed's pushed a lot of money over to the Swiss and other areas. The Fed window, they lend money not only to our banks overnight, but also overseas. And we're talking billions of dollars. And there's maybe next week I'll talk more in detail about that. There is some of that in the weekly report. You can read it. It gets, draw the night shades because you're going to fall asleep reading it, because it gets complex. But it is important to watch. But midterms are coming up. Historically, after midterms, 6 to 12 months, the market is responded in a very positive manner. We should be getting another interest rate hike, 0.5, 0.75 in November. Probably get one in early first quarter, maybe two. And then I think the Fed's going to hit their window of 4.5 to 5%, 5.25%. And if they say we're going to relax and we're going to wait on raising rates, that's when we go off. We should start putting a lot of our money to work. But not until then. Not until then. We're going to have some bumps and bruises. Why lose money? I mean, is my favorite saying. I was telling my kids the other day. I mean, hey, in August, everybody's saying, hey, it's time to get back in the market. Prices are low. And you heard it all over the news, the papers, everything, the websites. And, some of my kids were saying, hey, I want to buy Tesla. I want to buy Amazon. Okay, so you bought Tesla in August. It's down 29% since August. Down 29. Our TBT we bought, it's up 38. What would you rather have? NVIDIA. I know that's the darling of a lot of people. That's down 33% since August when everybody was saying, we hit the bottom. Kramer came out and said, this is a tradable bottom. I don't think now's the time to start buying our faves. Well, I can go through all the faves, not him, but that we had out there in the past. And they're down double digits. It's terrible. So you have to be careful. I want you to go to the Twomey Stock Market Report. That's the number 2, mestocks.com. Check it out. See what's there. See what's available online that's free. And then, if there's other things like you want to get more into the detail and be an active trader with me and the Twomey Stock Market team, I want you to get and sign up for receive the trade alerts. Absolutely free for the first 30 days in that. And then you'll get all the material, all the videos. You'll get them either emailed or a notice to you to go check out our website, where to find them. Every day, you'll get some type of instructional meaning if you're looking at these videos over time. You don't have to, if you get buy and trade alerts, you don't have to worry about your trade going south. In this market, how many times have we taken trades? The collective we meaning people that trade out there, and they wake up the next day and it's down 10%, or the next 2 days or a week or whatever. You go, it's going to come back because it always does. And then the video, you're down 33% in 9 weeks. So it happens. We all see it. It's happened to all of us, but I'm here to prevent that. I'm here to make that opposite, make you go higher. All right, check us out at ToomeyStocks.com. Today's Sunday, October 16th, 2022. Next week's going to be really interesting with earnings, and we might be at a tradable bounce, so stay tuned. Thank you very much. I'm James Tumi.